Welcome back to the channel, and in this video we're going to go over 10 things you need to include in your financial projections if you're going to IPO. If you're going to go for an initial public offering in your business, there's some additional considerations than just a regular financial projections. So my name is Nicholas Coriano, went to business school, went to law school. I've written over 2,000 business plans. It's what I do for a living for the longest time. And in this video, we're going to go over 10 things that you should include in your financial projections. Okay, so number one, and these are in no particular order, these are just additional considerations in addition to your income statement, your balance sheet, and your cash flow statement, and your statement of retained shareholders' equity. These are things that you want to include in your financial projections so investors understand, right, what's going to happen pre-IPO and post-IPO. Okay, so if you plan an initial public offering, listen up. Number one, market capitalization and valuation assumptions. So this could include initial market capitalization, your assumed IPO pricing per share, your post-IPO enterprise value based on your projected financials, and then your expected EBITDA and your PE ratio, and any other multiples or compared to your industry peers, right? So again, in normal financial projections, you probably wouldn't include this, but here you definitely want to have a market cap table, right? How many shares do you have outstanding? Who bought them? At what price? How many shares were sold? And how many shares are expected to sell? What's the price of the shares that you expect to share? What's that value totally diluted? And then what's your enterprise value after, right? So if you take in $200 million from an IPO and you use it on X, what is the valuation of the company after you implement that usage of those use of proceeds? And then you want to go through really every ratio that you can possibly go through, whether it's a PE ratio or an asset to revenue ratio, right? There's probably 10 valuation ratios, but anything that a stock would do after, right? Anything that like a Microsoft or a Google, if they have asset ratios, if they have debt ratios, if they have stock per earnings ratio, stock price per asset ratio, you want to try to put as many of those valuation assumptions in this section, which I call market capitalization and valuation assumptions. The next thing you want to include in your financial projections section, and again, this is in addition to your four basic financial statements. The second thing is IPO proceeds and capital structure. So what you plan on doing with the IPO proceeds, right? Break that down as thoroughly and as detailed as possible. So is it going to be for debt reduction? Is it going to be for research and development, or acquisitions, or an expansion, or organic marketing? You want to include the allocation of your IPO proceeds, and then a capitalization table before and after the IPO. So this is going to break down how many shares are outstanding, how much investors paid for them, how many shares they got, and how many different investors or shareholders you have. So this can include your existing shareholders. So this is going to be done pre-IPO and post-IPO. So it's almost like a pro forma cap table, right? Hey, this is how many shareholders we have now. This is the price they paid. This is how many total outstanding shares. And this is our market cap of our company today. And then once we issue these new shares to the investment banks or institutional investors or the retail shareholders, this is what our fully diluted new market cap looks like, right? And you want to include in this not just the existing shareholders, but your new public shareholders in the pro forma cap table, and then any lockup periods for insiders, right? So we know, okay, we have this many shares, but these many shares are opening up in 6 months. This many shares are opening up in 2 years. This many shares are opening up in 3 years. And this could be, insiders could not just be executives, but they could also be early investors, or they could be employees. And then any potential dilution impact of the new shares really should be delineated and highlighted here in this section. So keep that in mind. Number three, stock issuance and shareholder consideration. So the number of shares to be issued is one thing you want to include in this section. The stock retention plan for insiders and early investors, right? So if you have employees that have, you have an employee stock, an ESOP, which is an employee stock option plan. What does that look like, right? Are these people going to hold their shares? Do you have a lockup period for them? The early investors, are they allowed to sell 6 months after the IPO, 1 year after the IPO, 2 years after the IPO? You want to put that in your financial projections so they know, right, what the stock is going to be valued and how many shares are going to be outstanding. Any stock-based compensation, ESOP, like I mentioned before, and expected institutional versus retail investor breakdown. So are there going to be funds that hold on to a percentage? Do you want to allocate a certain amount of stock to funds? Do you want to or allocate a certain amount to retail? Now, only some of this can be measured, right? Because if a fund grabs your stock and then sells it to retail, you can't really control some of these things. But initially, when you're first selling the stock, right, you can have some kind of idea of how many institutional versus retail investors are going to hold the stock. So that's section 3. Number 4, revenue and earnings forecast with public market considerations, right? So you're forecasting your revenues and earnings, but you want to do it the way a public company would. So a couple bullet points here. Number 1, quarterly revenue and earnings guidance. So public companies provide to investors usually quarterly revenue and earnings guidance, right? Not all the time, but you sometimes they just tell you what happened for the quarter, but a lot of times they tell you, hey, look, this is what's going to happen over the next 3 months. So you want to keep that in mind when you're forecasting out. Don't just do yearly financial projections and don't give them monthly financial projections. Try to do it quarterly, just like you would if you were a public company. Earnings per share projections and future PE ratio. This is something that you wouldn't do if you were a private company. After you project out your revenue and your earnings really, you want to see what does that equate to per share, right? So your earnings per share. This is a metric that a lot of public companies use when analyzing or valuing their public company. Stock price sensitivity analysis based on revenue and profitability scenarios, revenue growth trajectory, and investor expectations alignment. So these are things that, again, compare yourself to other public companies, figure out, is how sensitive is my stock compared to, other companies in the sector. And then what's your growth rate? What is your trajectory? Where do you plan on being in Q1, Q2, Q3, Q4, Q5, Q6 after the IPO? Make sure you include that in your financial projections. These are things investors want to see. Number 5, public market liquidity and trading volume projections. You want to at least try to estimate, hey, look, there's going to be this much liquidity because we plan on attracting this many retail investors from our IR strategy. Or we plan on having this much trading volume because our market maker told us that they're going to trade this much stock or that they're going to keep the price at this price. So some things to include here: estimated free float, how many stocks are going to be out there being able to be traded in the public market, a daily average trading for volume forecast post IPO. So this is not as easy as it sounds. I don't know if it sounds easy, but to predict your trading volume is not easy. It's really a product of a lot of marketing, and really, the right partners you want involved there. So, good market makers, good broker dealers, good relationships with your investment banks will help your volume. And then any stock buyback or dividend policy plans, right? You want to include in this section. So if you plan on buying back stock or if you plan on issuing a dividend in the future, make sure you include that in your financial projections. Number 6, costs and expenses related to IPO and public company compliance. So these are not normally on a income statement, cash flow statement, or balance sheet, just because when you're a private company, the considerations aren't there. But when you go public, there's a whole line item. There's line items that otherwise wouldn't be included in your business, such as underwriting fees and legal costs associated with your IPO. Those are kind of one-time, one-off um, items that you need to report to investors before they get involved. You don't want to get clipped too expensive. So, you might show an investor who's already been involved in several IPOs your underwriting fees and legal costs, and he may say, hey, look, that's too expensive or that's too low, right? You're not allocating enough for legal costs. The last, 4 IPOs I did cost X, and you only have, X minus 50% there. So keep those involved in your financial projections. Any SEC reporting or compliance costs should be included in your financial projections. This has to include annually and quarterly reporting expenses. So this is, your legal compliance for filing with the SEC, your accounting, making sure you have a PCAOB accountant, your auditor expenses. All of this should be included annually and quarterly in your financial projections and for an IPO. Um, any investor relations and public relations budget for maintaining market presence. This is one that people miss a lot. They just kind of put it into marketing. It's not marketing, it's investor relations. So the difference is marketing, you can market your product or service, right? This is a normal business expense that will be in a private company financial projections. But when you're a public company, you're marketing your product and service on this side, and then on this side, you're marketing your public company, which in essence is what they call investor relations or public relations. And you need a budget for that. I've heard anywhere between 5 and 10% of of where you want your stock to be or what kind of volume or liquidity you want is usually what companies are spending on IR. Some companies are very creative with their IR. Some companies have no IR, right? Like a Tesla, they generally don't spend a lot on marketing their public company because they have such a strong leader marketing their public company. But most public companies, especially when you're just about to IPO, you need a strong investor relations and public relations budget to make sure that the investment community knows who you are. So make sure you include that in your financial projections. And then any Sarbanes-Oxley compliance or internal audit costs. So these are costs that, if you're internal and you have a complex structure, if you're a holding company and have a lot of subsidiaries, these costs are going to go up. You're going to have to audit that internally and make sure you comply with what they call SOX, Sarbanes-Oxley. There's going to be a cost to that. Make sure you add that in your financial projections. Number 7, debt and equity capital planning. So in the future, after the IPO, most companies don't just stop there with financing of their business, right? They may sell more stock in the future. They may sell bonds in the future. They may reduce the debt that they had previous to the IPO with some of the IPO proceeds. They may have a preferred stock class come out later. These are all things that should be included in your financial projections. So again, any debt reductions that you plan on using the IPO funds for, a debt to equity ratio post IPO, and any future capital raises. So any follow-on offerings, any secondary offerings, any convertible notes, any preferred stock that you plan on issuing, make sure you put that into your financial projections now, so that way investors can understand an honest approach to your business and say, okay, this is what we think in year 2 it'll be worth, in year 3, in year 4, according to what they said they're going to do with their secondary offering, convertible notes, preferred stock, etc. Okay. Number 8, risk factors impacting stock performance. So this can include a stock price volatility assumption, so impact on your financial stability, economic and industry risks that could affect future earnings, and liquidity risks and impact of insider sales on your share price, right? So this is not necessarily in an Excel file or in a financial projections, but it's kind of a write-up to let your investors or future investors know, hey, look, we've considered that some of these things may affect the stock price. We've considered that some of these things may affect the liquidity of the stock, and this is why, right? So any future sales of stock, any macroeconomic events like elections or tariffs or industry risks, they should all be put in there. Anything that you think will affect the stock price or could affect the stock price should be put into your financial projections. Number 9, dividend and shareholder return policies. Now, look, if you're going to issue a dividend, this is a primary example for a real estate investment trust, right? You take the real estate investment trust public, you plan on issuing a dividend every quarter as soon as you guys go public. Then you want to put that in your financial projections, right? What is the dividend payout per share? How does it affect the balance sheet? How does it affect the cash flow statement? How does it affect the income statement? You want to have that in there. If you have a policy for dividends, and this is only if applicable, some companies are like, hey, look, we're going to pay out 3% of EBITDA, 5% in EBITDA, 50% in EBITDA. You want to make sure to include that in your financial projections. Any expected yield or payout ratio, if applicable, you want to put that in there, and any reinvestment of profits or distribution to shareholders, right? So if you already have a strategy in place on, look, this is how we're going to use our profits, right? Or this is how or when we're going to distribute to shareholders, make sure you include that in your financial projections. And then the last thing to include in your financial projections that wouldn't be normally included in financial projections if you were a private company is mergers and acquisition strategy. So if you plan on any potential future M&A activities funded by your IPO proceeds, make sure you include that in there. And any impact for M&A on revenue and financial projections or any projected market expansion strategy post IPO with M&A, make sure you include that in your financial projections. So if there's a big chunk of money coming out because you plan on acquiring another business, obviously include that, right? And then those projections, make sure you highlight or asterisk any risks involved or any potential, outliers that you think will affect the financial projections. So those are just a few things. Remember, you're going to want to have your statement of retained owner's equity, your income statement, your balance sheet, and your cash flow statement. Those things don't change whether you're a private company or public company. But if you're a public company, make sure you include these other 10 sections. I'll go over them one by one. Number one, market capitalization and valuation assumptions. Number two, IPO proceeds and capital structure. Number three, stock issuance and shareholder considerations. Number four, revenue and earnings forecasts with public markets considerations. Number five, public market liquidity and trading volume projections. Number six, costs and expenses related to your IPO and public company compliance. Number seven, debt and equity capital planning, so anything in the future. Number eight, risk factors impacting your stock performance. Nine, dividend and shareholder return policies. And 10, mergers and acquisition strategies. So in addition to your basic financial statements, these are the things you want to include in your financial projections if you plan on taking your company public, regardless of whether it's an IPO, reverse merger, SPAC, or direct offering. So I hope this was helpful. In my last video, I went over things to include in your business plan if you plan on going public that wouldn't otherwise be included in the business plan. If you are a private company, check that video out. I'll put the link up here or up here. And hit that like button, hit the subscribe button, share with us any questions you have in the comments section, and join us next time. I put out a video every single Friday trying to help entrepreneurs, business owners, public companies, private companies grow, scale their business, write awesome business plans, put together awesome pitch decks, and implement awesome marketing strategies. So hope you guys enjoyed the video. I'll catch you guys next week.